Today, speculators let rip as central banks talk up higher rates. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and revenues with a distinctively Australian flavour. In this week's market review, we explore the fragile upswing in the second half of the week, which can be best understood as positioning by speculators betting on a falling market, typically seen as part of a bear market rally sequence, rather than anything more substantive. I believe the markets are still not fully factoring in the evaporation of a Fed pivot, at least for now, despite the intense and heightened rhetoric. Indeed, as I discussed yesterday, the current bout of inflation has predominantly been caused by overstimulation thanks to ultra-low rate settings, quantitative easing, and loose fiscal measures such as government stimulus. The truth is, this is now coming undone. Thus, I don't regard the slight end of the week upswing as a significant term. And as normal, we'll start in the US, because such a globally dominant market as that determines what happens here, then cover Europe, Asia, and we'll end up in Australia. So the Dow snapped a 3-week losing streak on Friday as technology sidestepped the ongoing chorus of hawkish Federal Reserve remarks that have pushed up the odds of a larger September rate hike and extended the melt-up in Treasury yields. Indeed, Goldman Sachs expects a steeper path for US rate hikes and a 75 basis point hike this month, as Federal Reserve officials have become more and more hawkish recently, according to the investment bank's analysts. They had previously forecast a 50 basis point hike in September. The analysts also raised their November forecast from 25 basis points to 50 basis points, and they see the Fed funds rate window at 3.75 to 4% by the end of the year. Fed officials have sounded hawkish recently and have seemed to imply that progress toward taming inflation has not been as uniform or as rapid as they would like. They said how the drag from tighter financial conditions will net out with other key growth impulses in 2023 is more uncertain, and we could imagine the hiking cycle extending beyond this year, they said. So no wonder investors remain jittery about the prospects of another outsized rate hike from the Federal Reserve. In fact, on Friday, Fed Governor Christopher Waller said the Fed should be aggressive with rate hikes while the economy, quote, can take a bunch. While Kansas City Fed President Esther George said taming inflation could be a tough task. Both came after Fed Chair Jerome Powell said on Thursday that the US Central Bank is strongly committed to controlling inflation until the job on reducing inflation is done. Fed funds futures imply about a 77% chance of a 75 basis point hike at the September policy meeting and a peak in the benchmark rate of around 4% by early 2023. And traders are pricing in a 90% chance of a 75 basis point rate hike at the next meeting, up from 57% just a week ago, according to CME's FedWatch tool. So why the rally on Friday then? Well, the major indices recorded their first weekly gains in 4 weeks, and the gains followed a sharp sell-off that began in mid-August, triggered by concerns about the impact of tighter monetary policies and signs of an economic slowdown in Europe and China. Analysts said this week's market recovery was more related to previous overselling as uncertainty remained high about inflation and the Federal Reserve's aggressiveness in interest rate hikes. It's not surprising we get a little bit of a bounce like we're getting here, as a lot of this is technical, said Jack Janusevich, lead portfolio strategist and portfolio manager at Naxos Investment Managers Solutions. I wouldn't be shocked if we started the week off with a little bit more strength and then we got to sort of settle down and give back a little as we get ready for the CPI, he added, looking ahead to next week. Investors await August consumer price report on Tuesday for any signs that inflation may be easing, and is expected to show that the prices overall rose by around 8.1% over the year to August, compared with 8.5% in July. Wells Fargo economists expect headline inflation to log its steepest monthly decline since the peak of the pandemic in April 2020, helped by a pullback in gas prices. Anyhow, all 11 major S&P sectors traded higher on Friday, with communication services, technology, energy and consumer discretion leading the way. Hammered since the beginning of the year over concerns about higher interest rates, high-growth stocks rose in the week. The volatility index, a gauge of investor anxiety, closed at a 2-week low of 22.79, but stayed above the long-term average of about 20. So the Dow Jones Industrial Average rose 1.19%, to 33,151. The S&P 500 gained 1.53% to 4,067, and the Nasdaq Composite added 2.11% to 12,112. And for the week, the Dow advanced 2.7%, the S&P 500 climbed 3.6%, and the Nasdaq climbed 4.1%. Now looking at individual stocks, Kroger jumped 7.4% after the grocer raised its annual forecast, and shares at Tapestry rose 2.7% after a luxury handbag maker said it expects revenue of $8 billion by fiscal year 2025. Energy also played a big role in the broader market melt-up, helped by advancing oil prices following recent reports suggesting the Biden administration is mulling whether to stop releasing oil from the US Strategic Petroleum Reserve after October. Halliburton Company, EOG Resources, and Baker Hughes led the gains in energy, with the latter up more than 5%. The earnings front also provided ammunition for bullish bets on stocks such as DocuSign and Zscaler. Zscaler reported quarterly results that topped Wall Street estimates on both the top and bottom lines, sending its shares up more than 21%, and DocuSign meanwhile delivered a better than expected Q3 outlook after reporting second quarter results that were ahead of estimates. In other news, construction equipment maker Caterpillar said it had reached a settlement to resolve a multi-year tax dispute with the IRS. One other critical point to note is the lack of market liquidity, though, and it's a problem that's getting worse at the moment, something which will become actually more of an issue ahead as central banks reverse their QE programs. One example is the reverse repurchase, the RRP. The New York Fed uses numerous repo programs to manage the supply of cash in the banking system, thereby maintaining the Fed funds rate within the FOMC's target range. It's employing its RRP program to accomplish that task. In an RRP transaction, the Fed sells securities to a counterparty and simultaneously agrees to repurchase them at a future date. The duration is often overnight. The transaction temporarily reduces the supply of money from the banking system. Increasing daily RRP balances results in less system liquidity, and a declining balance reduces liquidity also. Use of the RRP facility has been increasing rapidly and now sits at around $2 trillion daily. Rising RRP balances are a drain on liquidity. As money market yields rise, with Fed funds and asset markets performing poorly, investors tend to prefer higher cash balances. Such should keep RRP levels elevated for the time being. And while the RRP has been around for 20 years, it was scarcely used until early 2021. The various pandemic-related rounds of fiscal stimulus and massive Fed liquidity efforts left banks and money market funds with excess levels of cash. The excess liquidity would have pushed the Fed funds rate lower than the target rate without the RRP program. As such, RRP sucks up liquidity, making Fed funds easier for the Fed to manage. So it's actually a very good proxy for the liquidity risk, which is rising. And Bloomberg did a deep dive on more market dynamics, saying that in a week that saw discretionary buyers beat a quick retreat from risky assets, another set of traders stood up to halt a 3-week plunge in the S&P 500, those with little choice but to buy. They included short sellers whose rush to cover lifted stocks they've betted against to gains of more than twice the markets. Options dealers were another bullish force after getting caught needing to boost hedges by buying stocks when they rise. Certain quantitative traders for whom chart thresholds are a call to action also made their presence known. Combined, these players helped the market overcome a fresh wave of selling from day traders and fund investors. Up 3.7% over the holiday-shortened week, the S&P 500's advance flew in the face of Federal Reserve Chair Jerome Powell's persistent hawkish message. While it's debatable how much bad news is priced into 2022 bear markets, the prevailing skepticism towards stocks makes Andrew Slimon optimistic. There is just a huge negative bias for the market right now, and that is an extremely contrarian signal, he said. He's the global equity manager at Morgan Stanley Investment Management. Markets are set up for a very good fourth quarter. There are a lot of funds betting the markets are going to drop. And some cited a retreat in the dollar as another factor behind stock resilience, given that the recent chaos in the currency market supposedly created pressure for money managers to rein in risk. Others, though, pointed to the S&P 500's buoyancy itself as a catalyst for further gains. At the centre of the bounce is the battle line of 3,900, which acted as a support in mid-May and then kept a lid on advances briefly in June and July. After managing to close above that threshold during a retreat on Tuesday, the S&P 500 embarked on a 3-day rally. For rules-based traders, a calming market with favourable momentum is a green light to go long. Volatility control funds, for instance, snapped up $2.1 billion of stocks on Thursday alone, according to one estimate. As the market marched higher, it turned another set of price-insensitive players into buyers, option dealers who took the other side of derivatives trades and would need to buy or sell underlying stocks to maintain a neutral market exposure. Over the week, they were mostly mired in a short gamma stance that requires them to go with the prevailing market trend. Short sellers, whose wages looked precedent during the 2020 bear market, were caught wrong-footed as stocks bounced back. The need to cut losses forced an unwind that led to an 8.2% jump in a Goldman Sachs Group basket of the most shorted stocks over the week. Technically driven demand defied the growing drumbeat of Wall Street warnings and overshadowed what's increasingly a bearish army of fundamentally based investors. This year, cash holdings have risen in mutual funds and hedge funds. Equity exposures hit multi-year lows. And now retail investors, one of the staunchest dip buyers in the post-pandemic era, are reconsidering their bullish stance. During the week through to Tuesday, they sold stocks for the first time since June, according to a JP Morgan Chase estimate derived from public data on exchanges. Meanwhile, more than $10 billion was pulled out of equity funds, according to data compiled by EPFR. Bears will retort that gains were only held fleetingly and relied a great deal on short covering, said Michael Shahol, Chief Executive Officer at Markfield Asset Management. Although a good deal of Fed tightening has been priced into the market, the stubbornness with which many higher interest rates may be maintained in the face of a deteriorating economy has not been sufficiently taken into account. The whole year has been a dangerous one for bears and bulls alike. As alarming as Fed policymakers all sounded, inflation data out on Tuesday is likely to show weakening prices from generational highs. And whatever harm rate hikes may bring, the damage has yet to make its way to corporate earnings and the credit markets, although it probably will later. Buffeted by conflicting narratives, stock moves have made market timing all but impossible. After suffering the worst first half in 5 decades, the S&P 500 recouped half of its bear market decline during a 2-month 17% rally from mid-June. Once the bounce hit a wall at its 200-day average in August, the index quickly reversed its course and lost almost 10% before this week's rebound. The whiplash has prompted Suzanne Hutchins at Newton Investment Management to prepare for the unexpected. While having reduced overall equity holdings in anticipation of a prolonged downdraw, she recently bought bullish options as insurance. When you are in a long-term structural bear market, which we think we're probably in, you do get very, very sharp market rallies, said Hutchins, Senior Portfolio Manager and Head of the Real Return Strategy at Newton Investment. We've got call options to the upside on markets, should we be wrong. And more derivative shadows are cast also across gold, which continues to languish near multi-year lows after a rough summer, deeply out of favour with traders. Oddly, this leading alternative investment seems oblivious to the first inflation super spike since the 1970s. That should be driving bid gold demand, fueling a major upleg, but that classic inflation response has been temporarily delayed, at least by heavy to extreme gold futures selling. The biggest problem in gold markets is the extreme leverage intrinsic in futures trading that enables a tiny group of traders to wield wildly disproportionate influence over gold prices. This week, each contract controlling 100 ounces was worth $170,000 at $1,700 of gold, while traders are only required to maintain a cash margin in their accounts of $6,500 per contract, making for crazy maximum leverage of around 26.2 times. Running at 26 times leverage, each dollar traded in gold futures has 26 times the price impact on gold as a dollar invested outright. So gold future speculators punch way above their weights in dominating short-term gold price action. This is a fundamentally serious structural problem undermining gold fundamentals. As such, extreme leverage creates irresistible opportunities for price manipulation. In fact, recent US federal court cases have proven this out. Just a month ago, the former head of JP Morgan Chase's precious metals business and his top gold trader were convicted of manipulating gold prices from 2008 to 2016, and they faced decades in prison when sentenced. They did this through leveraged gold futures trading, including spoofing, that is, unleashing huge and bogus gold futures sell orders to hammer gold, which are then quickly cancelled before execution. During closing arguments in that trial, the federal prosecutor stated they had the power to move the market, the power to manipulate the worldwide price of gold. That brings the US Justice Department's secured convictions to 10 former Wall Street traders at JP Morgan, Merrill Lynch, Deutsche Bank, Bank of Nova Scotia, and Morgan Stanley. So there's no doubt that leveraged gold futures trading greatly affects gold prices. Thus, it desperately needs to be reformed dramatically to eliminate this extreme leverage that inevitably attracts fraudsters. 20 times to 30 times should be illegal, like in the stock markets where 2 times has been the limit since 1974. Even for the vast majority of gold futures traders who aren't criminals, such radical leverage is so exceedingly risky that it compresses their trading time horizons into very myopic, ultra-short term. Running 26 times, a mere 3.8% gold price move against specs positions will wipe out 100% of their capital risked. So all they can afford to do is chase hour by hour momentum, which is what they did this summer to slam gold. They can't care about gold's global supply and demand fundamentals, inflation, or even prevailing trends in gold and broader markets. All that matters is whether gold is rising or falling each minute. It was last up 0.43% to 1,727.25. And in oil, bottom fishing and market shorts not wanting to be naked before the weekend sent crude prices soaring on Friday, extending the recovery in oil, which hit 7-month lows earlier this week on an array of demand issues. In a relative calm, compared to the perfect storm that had hit oil bulls between Tuesday and Wednesday, US crude settled well above $85 a barrel, while UK Brent oil stayed over $90. There was about a 3% gain amid a CNN report from late Thursday that the Biden administration might stop dumping barrels from the US Strategic Petroleum Reserve, or SPR, on the market of October in a bid to keep down energy prices that have fed runaway inflation. Aiding oil's recovery was the dollar's retreat from its biggest rally in 2 decades. The dollar index, which pits itself against 6 major currencies, led by the euro, stood for a 3rd day in a row, reaching a low of 108.35 from Wednesday's 20-year high of 110.79. And those long in oil also leveraged old but positive news from earlier in the week that Russian President Vladimir Putin might shut down all energy exports from his country should there be more clampdowns by the West on the selling price of Russian oil and gas. Putin's threat to cut off all energy supplies is a growing risk as Ukraine recaptures territory, said Ed Moyer, analyst at online trading platform Onya. The risk of some supply disruptions over the next few months remains elevated, and that should help keep oil prices above $90 a barrel, he said. John Kudloff, partner at New York energy hedge fund Again Capital, concurred, yes, it's mostly bottom fishing on recycled news that's helping the markets extend its recovery today, including the one-off plan to release more SPR barrels after October. The point is, no short really wants to go naked into the weekend, especially considering how volatile things can get as a new week begins. US Energy Secretary Jennifer Granholm told Reuters in an interview on Thursday that the administration might consider extending SPR drawdowns beyond October, and Bloomberg cited several administration officials speaking anonymously as backing up the plan. But a CNN report later on Thursday quoted White House sources as saying the administration was not considering tapping emergency oil releases after October. While the CNN report was also linked to anonymous sources, it was lapped up more readily by oil bulls wanting to put a firm floor to the market after an 8% plunge between the close of Monday and Wednesday. The Biden administration has been drawing down the SPR since November last year, but outflows from the reserve recently accelerated in May when the administration embarked on a battle to bring down the spiralling pump price of gasoline that had bumped US inflation to 40-year highs. The president committed to draw down 180 million barrels from the reserve over 6 months, or roughly 1 million barrels per day, between May and October. At last count, the SPR had released a total of 123.8 million barrels since March, a figure that includes volumes associated with an earlier round of tenders. The SPR stockpile itself was at 442.4 million barrels last week. That's the lowest since November 1984. Gasoline reached a record high of $5.01 a gallon on the average at US pumps in mid-June before tumbling steadily on the back of the SPR releases. By Friday, it averaged down at 3.75 a gallon, according to the American Automobile Association. Some analysts say the price could actually get below $3 by October. The New York traded West Texas Intermediate, which serves as the US crude benchmark, settled up 3.06% at 86.09, and for the week it was flat. Prior to the rebound, WTI hit a 7-month low of $81.20 this week, pulverized by new COVID-19 lockdowns in top oil importer China. Brent, the London traded global benchmark for oil, settled up 3.67% to $92.19 a barrel. For the week, it was off just 18 cents or 0.2%, and prior to the rebound, Brent hit a 7-month low of 87.25 this week. So looking ahead, analysts are suggesting that WTI might reach $91 and even extend to $97, said one analyst. But should there be fresh capitulation under $85 next week, then the trapdoor's opening towards $77. Who knows? European stocks marked their first weekly rise in 4 on Friday, boosted by a surge in banking shares on expectations of further monetary policy tightening by the European Central Bank, while soaring metal prices lifted mining stocks. The Pan-European Stock 600 index rose 1.52% to close at a 1-week high of 420.36. European stocks briefly shed gains in the afternoon trading following reports that ECB policymakers are likely to kick off a debate next month about whittling down the €4 trillion bond pile. That comes a day after the central bank raised its key rates by an unprecedented 75 basis points and promised further hikes. Several money houses are forecasting another 75 basis points hike in October. In fact, a second consecutive hike of 75 basis points would match the 2 most recent moves by the Federal Reserve, underlying the more aggressive approach adopted of late as inflation in the 19-nation Eurozone breaks records. Klaus Knott, an ECB Governing Council member, said that the European Central Bank must raise interest rates further to prevent record Eurozone inflation from spilling over into wages, reinforcing the hawkish message from this week's historic hike. Thursday's 75 basis point move was a powerful and big signal, but more steps should follow, Knott told Dutch radio on Friday, warning of a big risk of second-round effects. The aggressive tone was evident amongst his colleagues. Slovakia's Peter Kalmica called for resolute hikes to tackle unacceptably high price gains, and Estonia's Madis Muller warned that delaying rate rises too much risks needing a much sharper break on the economy later to bring prices under control. Bank of France Governor Francois Villeroy-de-Gaulle urged orderly but determined action, though he cautioned that the outsized rate increase doesn't mean that the ECB has developed a jumbo habit. The comments underscored the tougher stance adopted by the ECB since it lifted borrowing costs for the first time in more than a decade in July. Now, they were, of course, accused of acting too slowly, and they're now matching the Federal Reserve's path. Traders are in risk-on mood even through yesterday, and there was a rate hike from the ECB and hawkish commentary from Fed Chair Jerome Powell, said David Madden, market analyst at Equity Capital. It is possible that dealers are getting used to the idea of interest rates being increased and elevated bond yields. Eurozone banks, rocked by worries over their profitability in a low interest rate environment, jumped 3.2% to mark their biggest percentage gains in almost 2 months. The index, though, is still down 16.3% over the year to date. Miners jumped 3% as the softer dollar and fresh stimulus for China's slowing economy boosted prices of industrial metals and iron ore. And EU energy ministers met in Brussels to hash out radical measures to tame runaway energy prices and keep the lights on across the continent. The task in hand is to prevent the Russian gas cutoff from unleashing rationing, blackouts, and even social unrest. As the ministers try to find a unified solution to rescue businesses and households from mounting bills, they also need to make sure the emergency intervention doesn't end up breaking energy markets and making matters worse. Whatever the decision, it's likely to take several weeks to put any plan into action, with detailed proposals expected to be unveiled by Commission President Ursula von der Leyen in Strasbourg next Wednesday. Belgian Prime Minister Alexander De Croo warned that Europe needs to act immediately to address the energy crisis or risk the kind of economic shutdown that the bloc would struggle to recover from. And the EU should impose a broad price cap on gas, offering a markup on Asian prices to secure supplies, he said. European natural gas prices jumped following the comments. While the Stoxx 600 managed to end up the week 1.1% higher, investors doubt whether the rally can be sustained as Russia turns off its gas taps to Europe indefinitely amid a brewing cost of living crisis in the region. We remain negative on European equities given a backdrop of heightened geopolitical and energy uncertainty at the same time as central banks are tightening policy into an economic slowdown, Morgan Stanley said. The DAX in Germany rose 1.43% to 13,088, while the CAC 40 in France lifted 1.41% to 6,213, and the FTSE in London was last at 7,351, up 1.23%. Telecom Italia shares rose 2.8% as sources close to the matter said it was close to kicking off a process to sell a minority stake in its enterprise service arm. Now, most Asian stock markets rose on Friday, tracking an extended recovery in Wall Street as the dollar and Treasury yields came off recent highs, but hawkish signals from the Federal Reserve kept broader gains capped as investors priced in an 85% chance plus that the central bank will raise interest rates by 75 basis points in September. Still, a strong lead-in from Wall Street put most regional markets on track for weekly gains. Shanghai's composite index rose 0.82% to 3,261 after substantially weaker than expected inflation readings for August drove up expectations of more stimulus measures by the Chinese government. China's consumer and producer inflation slowed in August as sporadic lockdowns suppressed spending and commodity prices fell, giving policymakers enough room to support the troubled economy if needed. The Consumer Price Index rose 2.5% from a year earlier, according to the National Bureau of Statistics. That's down from 2.7% in July and weaker than the 2.8% forecast from economists. Factory-out inflation slowed to 2.3% from 4.2% in July. That was lower than the 3.2% predicted in the surveys. Consumer prices in China have remained mild this year compared to the soaring costs in the US and Europe, where central banks have been hiking interest rates in an attempt to tame inflation. The People's Bank of China has taken a divergent path, cutting interest rates last month to spur an economy hit by COVID outbreaks and an ongoing property market slump. Friday's data reflects soft domestic demand and suggests that further easing is needed to stabilise growth, said Liu Pequin, chief China economist at NatWest Group. A slower than expected pickup in food prices gives policymakers more room for easing in coming months, she said. Beijing has already promised to increase spending in the third quarter as China's economic growth slowed to a crawl this year due to continued COVID-related lockdowns. The Chinese stock indices were set to gain 1.4% and 2.2% for the week, breaking a 3-week losing streak. Hong Kong's technology-heavy Hang Seng Index was the best performer of the day, jumping 2.69% as easing yields benefited major tech stocks. The Bats trio, Baidu, Alibaba, and Tencent holdings all rose somewhere between 1.7% and 4%. But losses in Tencent earlier this week, amid speculation over a share sale by a major stakeholder, put the Hang Seng on course for a 0.6% weekly loss. Now in Australia, mining stocks helped Australian shares to a second day of gains on Friday as the market closed at its highest level this month. Traders largely looked through the death of Queen Elizabeth II and pushed up the ASX 200 by 0.66% to 6,896 as some weakness in the US dollar soothed investor nerves. The larger All Ords index also gained, rising 0.8% to 7,139, and the Aussie dollar was 68.38, that was up 1.29%. Friday's gains brought the ASX 200's weekly gain to 1%, helped by a massive 1.8% gain on Thursday after Reserve Bank Governor Philip Lowe hinted the bank might reduce the pace of interest rate rises. The materials sector lifted 3.3%, helped by a 13.6% jump in mineral resources to $71.50. And the miners rose sharply on talk it might spin off its lithium business. Lithium producer Pilbara Minerals also added 5.9%. Most of the major miners traded higher on Friday, with BHP up 3.17% to 38.09, and Fortescue Metals added 6.14% to 17.81. Rio Tinto, South 32 and Newcrest all gained between 2.7 and 3.8%, while De Grey Mining jumped 11.9% and Samphire Resources rose 8%. Elsewhere, the energy sector gained 1% as Whitehaven Coal and Yancoal both added more than 3%. Consumer staples stocks fell 1.2%, with both major supermarkets Coles and Woolworths in the red, alongside Endeavour Group and Treasury Wine Estates. Shares in takeover target Ramsay Health Care fell 1.3% to $70.10 after it announced the end of discussions with IHH Healthcare over the latter's bid to acquire 100% of Ramsay Sime Derby, a 50-50 joint venture in Asia. And Tyro Payments added another 9.5% after it snared a takeover bid on Thursday. And Bitcoin led a late risk-on rally up 9.8% to be back above 20,000 US at 21,303 at last look. Finally, according to a report, real estate prices across Asia are cooling. Home prices held up across most of the globe in the second quarter, with just 7 of the 56 markets surveyed by real estate agent firm Knight Frank showing price declines in June compared to March. Of those, 6 were in the Asia-Pacific region. New Zealand, which was one of the world's hottest markets during the pandemic, led the way with a 3% decline. Malaysia, Australia, China, and South Korea also slumped. Higher interest rates have cooled the sizzling price gains posted across much of the world during the pandemic, including in the US. On an inflation-adjusted basis, home prices across the world gained 1.6% in the first 6 months of 2022. That's down from 6.2% a year earlier, according to Knight Frank's report. So if you stand back, the message from today's show is clear. Most markets are being driven by wild speculation, not fundamentals, at least for now. And the question I have is, will this change ahead? Well, we'll see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.